Dealing with uncertainty is at the heart of any investment decision, be it a decision taken by a company to build a new plant, by a household to build a house, or be it by financial market participants. In this video, I will focus on financial markets and how they deal with uncertainty. At the current juncture, we can look at short-term sources of uncertainty. We can look at whether inflation will go down sufficiently quickly, whether central banks will keep on hiking the policy rates. Beyond the short term, you also have other sources of uncertainty, other types of uncertainty. One can think about, will interest rates go down? Will policy be eased next year under the scenario that inflation would have declined rather significantly? Or will there be a recession within a couple of months? The key element in dealing with uncertainty is the timing of the resolution of uncertainty. What does that mean? Resolution means that you know that the decision that you have taken in the past was the right one or has turned out to be the wrong one. And the timing is, of course, the moment at which you know whether the decision was right or wrong. The way that financial market participants should deal with uncertainty depends on the interaction between the source of uncertainty, the decision horizon, and the conviction level. Let me illustrate this with one example. Consider an investor that a priori has a longer decision horizon. That means that by taking a decision today, he or she commits for about 1 year's time. The way that investor will invest will depend on the source of uncertainty, but the conviction level. So if the conviction level is sufficiently high that, for instance, the US will go in recession, although it's not a certainty, there is unknowns around that, but if the conviction level is sufficiently high that the US would go in recession, that investor would probably decide to sell his equity holdings based on the historical experience that when you have a recession, typically in the run-up, equity markets go down. Still, such an investor would reflect upon the following question. He would say, well, but how should I deal with short-term thematics that may go in the other direction? For instance, if there is the view that central banks have tightened policy sufficiently, it could give an additional boost to equity markets. So it may be tempting, despite the long horizon, to still play short-term thematics. Let me now give the other example. Another example is you have a priori a long decision horizon. You want to commit for, say, a year's time, but you have a very low conviction level. You are faced with a lot of uncertainty and you have no idea what actually could happen. So there, inevitably, you will be forced to shorten your decision horizon and to play short-term thematics. A key takeaway from the previous point is that when uncertainty about the longer run, that is 6 months and beyond, is elevated, as an investor, you have an incentive to adopt a short-term horizon, even though a priori you wanted to commit for a longer investment period. Another reason why you would actually prefer to adopt a shorter horizon is when the drivers of markets in the short run are very different in nature from those in the longer run. And this can be perfectly illustrated by what is happening since the start of this year. The short-term driver of markets has been the hope that we are getting closer to the terminal rate. That is the peak policy rate in this cycle, be it in the euro area or be it in the US. As you get closer to the peak policy rate, this has been an element that has been boosting risk appetite of investors. But at the same time, there is this longer term uncertainty, which is that, yes, but what's going to happen to growth? Will the US enter any recession, yes or no? And if these growth fears would increase, that of course would have a negative impact on markets. So the hope of getting closer to the peak policy rate is a positive element for markets. Recession fears would be a negative element for markets. So what investors tend to do is they play the short-term thematic, and at some point they will switch their holdings and they will then start to focus on what is going to happen to the growth outlook when we get a clearer picture of that. The conclusions of that type of behavior is that there is a concern that in the short run, it could actually lead to overshooting, to an excessive compression of risk premia. That is, that the valuations would become expensive in a number of asset classes. But also it will bring another implication, another consequence is that it brings a prospect of heightened volatility as time goes by. Because as time goes by, at a certain moment, one thematic that has been playing a big role, are we getting closer to the terminal rate, will have run its course and market attention will start to focus on what the growth outlook is for the remainder of this year and for 2024. I thank you for having watched EcoTV Week this week and invite you to join us again next week. Thank you.